All right, so if you've got money sitting in a 401k or a traditional IRA, we really need to talk. There's a specific rule you absolutely have to understand because, honestly, messing this up can be brutally expensive. It's called a required minimum distribution, or RMD. Today, we're going to break down exactly what RMDs are, go through the big new rule changes that are confusing everyone, and most importantly, show you how to get out in front of them. Now, calling it a tax bomb might sound a little over the top, right? But it's actually a pretty accurate way to think about it. You've done everything right. You've saved for years. You've watched that balance grow. Tax deferred. But here's the twist. The government has been patiently waiting for its share. An RMD is the spark that can set that whole thing off. So let's figure out how to disarm it. So what exactly is an RMD? At its core, it's the moment when Uncle Sam finally steps in to collect on a very long-standing IOU. Let's be absolutely clear. The most important word here is required. This is not optional. It's not a friendly suggestion. Think about it. All those years your money was compounding inside a traditional IRA or 401k, you weren't paying any tax on that growth. That was a fantastic benefit, but there was never a scenario where the IRS would just let that money sit there tax-free forever. An RMD is simply the government's way of saying, all right, time's up. You have to start pulling money out now, and we're finally going to tax it. And this idea really captures everything, doesn't it? This is the entire arrangement in one sentence. Every contribution you made and every bit of growth you earned was built around a trade-off. You got a tax break up front, and the government reserved the right to tax it later. The RMD is just the moment when the bill finally shows up. So that's the what. We're clear on that now. Let's move into the when. And this, my friends, is where things recently got extremely confusing. It's where a huge number of people are stumbling, because the age rules have changed, and the fallout for getting it wrong has never been more severe. For a long time, you probably remember hearing that age 71-2 was the magic number. That's what everyone planned around for years. Then the starting age moved up to 72, and just when people started to adjust to that, boom, the Secure 2.0 Act came along and rewrote the rules yet again. Now there's a brand new system for figuring out when your RMDs have to start. Okay, pause for a second and really look at this chart. This is the single most important element of your retirement planning. The logic behind it is actually straightforward. If you were born before 1960, your RMDs start at age 73. That's it. Easy enough. If you were born in 1960 or later, you get a longer runway. Your starting age is 75. Find your birth year on this chart and lock in that number. That age effectively sets your entire RMD schedule. So what happens if you blow it? What if life is hectic, you lose track, or you misjudge the timing? The fallout is serious. This is what a lot of financial professionals call the penalty trap. And believe me, it's a trap you really do not want to fall into. 25%. Just let that sink in. This is not a tiny fee. It's one of the biggest, most painful penalties the IRS can hit individual taxpayers with, often just because of a simple mistake. And here's the crazy part. This is actually better than it used to be. The old penalty was 50%. Yes, 50. So 25% is the reduced version. So how does it work in real life? It's not a penalty on your entire account, thankfully, but it is a 25% hit on the amount you were required to withdraw for that year and didn't. Let's put some numbers to this so you can really see the impact. Imagine you've done a great job saving. You've grown your IRA to $1 million. That's a huge accomplishment. Now, based on the IRS life expectancy tables, your required distribution for the year might be around $42,000. If you forget to take that out, if you miss the deadline, you don't just owe income taxes on that $42,000. The IRS also tax on an extra $2,500 as a penalty. That's basically a $10,000 mistake for just one missed year. Calling that ouch is almost too gentle. Now, I know that sounds intimidating, and it should. But here's the single most important thing I'm going to tell you about this penalty. It is totally and completely avoidable. This does not have to happen to you. The goal here is not to scare you. The goal is to use the existence of that penalty as fuel to get a proactive plan in place. This is really about taking control. All right, let's move past the scary stuff. We've defined the tax bomb. We've identified the trigger. We understand how painful the penalty can be. Now let's get to the good news. How do you actually diffuse it? The best part is, you're not stuck sitting on the sidelines. You can absolutely take command of this situation and manage the tax hit using some smart planning moves. So, to quickly revisit why we use that bomb analogy, it's because RMDs create forced income you might not want or need, and that extra income can set off a chain reaction. First, it can nudge you into a higher tax bracket than you ever expected to see in retirement. Second, and this is the one people constantly overlook, it can cause a larger chunk of your Social Security benefits to become taxable. It's a triple threat to your retirement cash flow. The number one strategy for diffusing this bomb is, without question, the Roth conversion. The logic behind it is elegantly simple. Instead of waiting until your 70s for the government to force withdrawals from your IRA, you voluntarily pull money out earlier. You pay the tax bill now at today's rate and roll those dollars into a Roth IRA. The real brilliance is all about timing. Many retirees go through a sweet spot phase in their early retirement years, after they've stopped earning a paycheck, but before Social Security and RMDs start. During those lower income years, you can convert portions of your IRA, carefully filling up the lower tax brackets. Once the money lands in the Roth, it grows completely tax-free. And here's the knockout blow. Roth IRAs have zero RMDs for the original owner. You've just taken what would have been a future tax problem and turned it into a powerful tax-free resource. All right, Roth conversions are phenomenal, but what if you're already someone who gives regularly to charity? In that case, there's another incredibly effective tool you can use. It's called a Qualified Charitable Distribution, or QCD, and it delivers a very special kind of tax advantage. This bar chart shows the value of a QCD perfectly. Let's go back to our $42,000 RMD example. If you simply take that distribution as usual, as you can see in the first bar, you've added $42,000 of taxable income to your return for the year. Straightforward, but if you use a QCD, you tell your IRA custodian to send that exact same $42,000 straight to a qualifying charity. The funds never flow into your bank account, and because of that, they never show up as income on your tax return. Look at that second bar, zero additional taxable income. It's incredible. You've met your RMD requirement, but your taxable income doesn't increase at all. It's a genuine win-win situation. You support an organization you care about, and you satisfy the IRS in the most tax-efficient way you can. So we've gone through the what, the when, and the how. We've outlined the challenge and highlighted some strong solutions. But you and I both know that information alone doesn't change anything. Action does. So let's pull everything together into a straightforward action plan. Something practical you can actually use to move from theory to execution. Here's a simple 4-step roadmap to get ahead of this. Step 1. Map out your future income. Include everything. Estimate your Social Security, any pension benefits, rental income, all of it. Step 2. Approximate your future RMDs. You don't have to be exact. Just come up with a reasonable estimate. There are plenty of easy online calculators that will help. Step 3. Pinpoint the risk. This is the critical part. Add your estimated RMD on top of your other income and then look at the tax brackets. Does that new total shove you into a bracket you're not comfortable with? And finally, step 4. Based on what you find, start evaluating your options. You'll have a clear picture of whether it makes sense to use Roth conversions to smooth out your tax bracket, or whether a QCD-focused approach better aligns with your personal priorities. And ultimately, that's what all of this really circles back to. It comes down to this simple but absolutely vital question, because these mandatory withdrawals are not a tiny detail you can casually address later. They're a huge, central factor in your retirement strategy. If you ignore them, you're effectively handing the IRS control over a big piece of your financial future. But if you anticipate them, if you plan around them and act early, then you're firmly in the driver's seat, safeguarding the retirement you've spent so many years working to build.